Assalamu alaikum friends. Welcome to question number 16 of SBR. This is also a full consolidation question like question number 15. Okay, but the only difference is there here we have an overseas subsidiary, right? So that means we have to deal with IS 21. We have to use foreign currency. We have to use the exchange rate to convert to home currency. So there will be a translation gain or loss relating to it, which we need to deal with. Okay, so please note that in SBR in your exam you will not be asked a question like this where you have to make a full consolidation accounts. Okay, but this question number 15 and 16 especially, I would suggest that you attempt these questions because this will help you to know a lot of consolidation issues. It's like a revision for you, whatever you have learned. Okay, you will not be asked a full consolidation consolidated financial statements, but extracts you might be asked the extracts of it. Okay, but let us see this. So you have been given rose, petal and stem. Okay, and you have been given the statement of financial position. Now we have two information regarding it, and let us read the requirements first. Prepare a consolidated statement of financial position of the Rose Group in accordance with IFRS, showing the exchange difference arising on the translation of stamps net assets. Ignore deferred taxation. Okay, so you can ignore the deferred taxation. Let me. Yes, you can ignore the deferred taxation. This question is similar to 15. The only thing is here we have exchange differences. Okay. B. Prepare a brief memo for the directors of Roche which identifies the correct accounting treatment of the various races issued. This is for 8 marks. So let us read the case study. Okay. So Rose acquired 70% of equity in Petal, that's a subsidiary, for 94 million. Net asset is 120 million, excluding the patent below. Okay, there's a patent below. Patent is an intangible asset. So that means you have to know how to deal with it, and also that with that comes amortization. Okay, don't forget the amortization. And net asset of Petal at 1st of May 2000 included a patent which had a fair value. Okay, what is that fair value? 4 million. This had not been recognized in the financial statements of Petal. The patent had a remaining term of 4 years to run at the date and is not renewable. 4 years. The reason they are giving you is you to amortize, find amortization. Retained earnings. Okay, the retained earnings. This is your at the date. Okay, accusation 49 million. Retained earnings at the date of accusation. Other components of equity 3 million. The remaining excess of fair value net assets due to an increase in the value of land. So because of the increase in value of land, that means the increase in the value of land, if you want to find, that is the balance between the net asset opening and the closing net asset. Next we have Rose wish to use full goodwill method. Okay, the fair value of NCI is, so NCI is 46 million. There have been no issues of ordinary share since acquisition of goodwill on acquisition not impaired. Goodwill is not impaired. So the moment goodwill, they say goodwill on acquisition is not impaired, don't try to impair it. Okay, ordinary share remains same. Rose acquired further 10% from NCI in Petal on further 10% from NCI means from 70 another 10, so 8 becomes 80%. Okay, this question is very similar to question 15, so please go through 15 question and 16, do together and see the differences and similarities you can see. Okay, so further, and on this one the cash for cash consideration you have bought this 10% for 19 million. Okay, Rose acquired 52% of ordinary shares on stem 52, still it's a subsidiary. 52 is also a subsidiary. Okay, same date. Retained earnings, if you see, it is in dinars. So the stem is a problem here. You need to convert the dinar to dollar. Okay, for the stem. The net asset for stem is 490 million. Excess of fair value is for due to increase in value of land. Same for the stem and this one. And here also full goodwill method. NCI is 250 million dinar. And here also no impairment. So this is, they have kept it very easy. You have been given the exchange rate also. Now you can prepare. So the first thing, okay, just The way I have done question number 15, I'm going to follow exactly the same. I'm going to go through the workings first. So you start with the group structure, working number 1. Okay, if you see here, working 1, you start with the group structure. Okay, rows have acquired petal and stem. From this, so you write the date when it was 70% and from which date it was 80%, and here it is 52% for the full year. Next working, same like question 15, the working numbers are also same, didn't change. Only the numbers changed and the name of the company changed. That's it. Rest is same, so I can go a little bit faster in this question. Question number 16. So here, this is the pro forma which you need to memorize to find the net asset, acquisition date and reporting date. Reporting date, you have to look at your statement of financial position. Okay, and this is for whom? For petal only. Okay, share capital will remain the same always. Okay, unless they give you some issue of share or something, which they normally they don't give, they keep it same for to make it simple. Other equity, this all this information here onwards are given in your point number 1. Okay, this 2 has been given. This you can get from the, sorry, this 2 has been given, 3 and 49. 4 and 56 are there in your statement of financial position, and this is the balance figure. Okay, this has been given 120. Okay, net asset. This you still cannot get. Okay, this will be, you take it here and take it here. Okay, acquisition date, whatever is there, the balance you will take it in the reporting date at the year end also, and write it 30. It will be same only. Okay, this is given fair value of recognized net asset. Now you need to adjust it. Why? Because there's a pattern of 4 year. This 4 year you have to take. Okay, at the acquisition date you don't take amortization. Remember, you never take whether it's depreciation, if it's non-current asset, if it's intangible asset, is amortization. Either depreciation or amortization, you never take it on the acquisition date, because obviously we calculate depreciation amortization at the year end, right? So you don't take it acquisition date. But patent is for 4, so add that 4 with net asset, because it was excluding the net asset, the fair value of net asset. You have to include that patent here. Patent is a part of a net asset. So 120, 124. With this 124, you deduct 38 plus 3 plus 49. The balance is 30. This 30 is only you take here. So you add all this 4, you will get 128. Okay, 128 you will get after you add all this 4. Okay, 4 is 4, same. Here amortization you have to adjust. They told useful life is 4 years, so 4 divided by 4 is 1, minus that amortization from the reporting date, you will get 131. Okay, the reason why you are doing is because you need this to in your retained earnings and all, and also for your NCI goodwill when you're calculating the net asset you need. Okay, so of the net increase, how much it has increased from 131 to 124? 7 million, right? The difference between 131 and 124, difference between this and this. Okay, out of that 1 million goes to other components, 6 million goes to retained earnings. Remember these things, because when we do other components of equity and retained earnings, we will take this 3 and 6 million there. Okay, the difference between the acquisition and the reporting date of retained earnings and other equity, from 3 to 4 and from 49 to 56. Okay, now the same thing under this working only we'll do for stem also, but here it is in dinars, currency changed. Okay, because share capital in the acquisition date is also given to you in dinar. In the other information, reporting date in the statement of financial position is also given in dinar. So share capital is 200, no other equity is there. Return earnings is 220. This one is taken from the information. Okay, the 220 it's given there in note 1 or 2. Fair value adjustment, here also it is the balancing figure, 75. This is given to you. This and this is given to you, 495. Okay, so then you get 575. Here also the difference between this two is the 80 dinar is the net increase. Out of this all relates to retained earnings, nothing is for other components. Okay, because stem does not have other components of equity. Third working is goodwill. I'm going a little bit fast. The reason is similar question to 15. So if someone is unable to understand this, you can refer question number 15. I went slow over there and I've explained everything in detail. So I'm assuming that you saw my question number 15 video. That's why I'm going a little fast in question 16. And this is also, the good news is this is also the last question for group accounting. 30 marks question in SBR. Okay. Here onwards we are going to do 25 marks question. which comes in section A, which is question number 2, and your two professional marks, which you will be getting an ethical question, will be doing solving that. So petal. So goodwill we know. For petal also we have to find. For stem also we have to find. Okay, goodwill, fair value at consideration. Remember, goodwill we will calculate when we first acquire the 70%, not in the additional 10%. Okay, because it's subsidiary to subsidiary. So 94. NCI is already given to you. Net assets we just now found. Which net asset are you using? 124. It is this. It is this one. Okay, this 120. Not at the reporting date. Accusation date. Same for stem also. Reporting date, not reporting date. Accusation date only. You are taking the net asset when you are calculating goodwill. Okay, you deduct it. Goodwill you get no impairment, so it's easy. For stem also, remember this is in Dena. Okay, everything has been given to you in Dena. Okay, the fair value of consideration. You take all this thing in Dena, will convert later. 31 Dena will later convert into dollar. Okay. That is better rather than converting everything in dollar. Some might ask why not we convert everything to dollar and then goodwill will automatically be in dollar. The reason is because the which we don't know which exchange rate to use is more confusing. We might use different rates for different things. So better write everything in dinar, write the goodwill in dinar. Later we'll convert the dinar figure by using the closing exchange rate. We'll convert the goodwill in dinar into goodwill in dollar. Okay, so we start with fair value of consideration. It has been given to you as 46 million in dinar in dollar. Okay, so don't write in dollar. Okay, convert this into dinar. How do you convert? Accusation rate is 6. We'll go and see the rate. It's very important that you pick the correct rate. Which rate? This rate. Because at that date only we acquired. Okay. It is dinar to dollar. Always you have to know when to multiply and divide. Okay. It is dinar to dollar. That means 6 dinar equal to $1. $2 means equal to $1. So if you want to have something, what is the exchange rate? It has been given as 46. So if it is 46, it is dollar, right? So you multiply 46 by 6. Cross multiplication to get in terms of dinar. Okay. Because everything else is given in dinar, so that is given in dollar. So make everything in one currency. Okay. Whenever you have that issue, when majority of the things are given in one currency, keep it in that currency. If only one thing is in a different currency, change that one currency to other thing rather than changing everything. Okay, so that final goodwill figure only you have to change using the closing rate, because goodwill comes in is a part of an asset which comes in the statement of financial position. Therefore we use the closing rate to convert the goodwill. Okay, what is it? 46. You see, NCI interest is $46. It has been given to you in dollar, whereas everything else has been given in terms of dinar, right? So we take it. NCI is given dinar. Net asset acquired we just now found out. Okay, 495. Working 2 you will get 495. Okay, it is already in dinar, that 495. So you take it, deduct goodwill 31. Okay, that is in dinar. Now convert it. Okay, so goodwill is deemed to be, please make sure that you write the statements, okay, with calculations. So goodwill is deemed to be an asset of subsidiary. Why we are taking closing rate, that you need to explain. Because it is an asset. Because it is an asset. Okay, it is an asset of the subsidiary, and it is translated as the closing rate at each reporting date. So goodwill in stem is therefore this is the rate. Okay, closing date, that 31D divided by 5. Okay, When you're converting into dollar, you need to divide by 5. Okay, which rate out of this two? It's 5. This closing date. Okay, not the average rate. Average rate is taken for the amortization. Profit and loss account items comes there. So you have converted. Now the fourth item is NCI. Same question 15 also we had working number 4 is NCI. Okay. So here, what do we do? When we have acquired petal, whatever the NCI we have calculated, that we are taking 46. Okay. Remember, everything is in dollar. Okay. So the stems NCI was given in dinar, that you need to convert into dollar first. Okay. But with petal, there is no issue. Petal you can take first. Okay. First, deal with all the petal issue. Then we'll go to the stem. So here also, post acquisition net asset, we saw what is the movement in net asset in working tool, right? This minus the, they're showing here again 30% of it you have to take, because 70%, and we are not taking after adding that, after taking that additional 10%. Okay, 70 plus 10, 80. No, we are taking it when it was initially acquired. One time only we are calculating NCI. Second time there's a reduction in NCI when you have acquired. That reduction we need to calculate here. Reduction in NCI due to share purchase. Working 10 is there. We'll go to working 10 later, but you have to deduct it here. Okay, 16.03 when you're calculating NCI. Now we are going to the stem. We are over with petal. Stem, remember this was given in dinar, 250 million NCI. This you need to again divide by 6, the date when you have acquired it, to get it in terms of dollar, because everything is in dollar here. So this is the dollar amount. Okay, this is in dollar, and this is also in dollar. Next, same how you have done for one company, second company follows up. Post acquisition net asset. Okay, that net asset has been given to you as D80. You need to divide it by 5.8 and take 48% of it, because 52% you have acquired, so 48 is the NCI. Okay, post acquisition net asset, the change in net asset was 80. Okay, you divide it by 5.8. Which rate are you using? Because it is 5.8. 5.8 is the average rate. Okay, if you see here, 5.8 is the average rate you are taking. Why are you taking the average rate? That's a question to ask. Why are you taking the net asset? You can even take the closing asset also, or closing rate also. Because in the net asset, we have amortization. Okay, at the reporting year end, we have the retained earnings also. So anything relating to retained earnings goes in the profit and loss account. So they use average rate. That's why we are using, based on that assumption, we are using average rate here. Okay. So exchange gain. Remember, if anything there is an exchange gain, needs to be there under NCI. Relating to NCI, whether it's goodwill, whether it's exchange gain on net assets. Because of foreign exchange, you will have exchange. It could be loss also. If it's gain, you add. So one thing you need to add is exchange gain on goodwill, because when goodwill you change using exchange rate and all, there's a gain. And another gain is exchange gain related to net asset. Working 9 is there for that. So this is the NCI. Okay, we'll definitely go through those working and then you will know. Retain earnings, this is the fifth. Okay, you take rows. Okay, the parents 100% return earnings you take from statement of financial position. With that you add rows as return earnings, not what is given to you in the statement of financial position. You need to take this. What is it? 70% of 70% of 70% of wait, let me, it is 70% of 6 million. How 6 million go to working to the moment, the retained earnings, how much it has changed from acquisition date till the reporting date, that change into 70% after you have acquired that other 10% also. Sorry, you have initially acquired 70%, right? So that 70% you have to take, not the 80%, 4.2. And for STEM, it is 52%. The parents' share only you're taking. Remember that. Return earnings when you're taking. It was D80, but you need to divide it again same rate, 5.8, average rate, okay? Let us say you take average rate. On that you have to take. So first you divide 80 by 5.8, then take 52% on it, okay? Even if you take 52 multiply by 80 divided by 5.8, it gives you the same result. So add all and the return earnings you will get. Other components of equity same. Add all the three rows 100% from petal. There's a negative movement in equity. Okay, that needs to be deducted. Why negative movement in equity? Remember when you purchase additional this thing. Okay. There could be a negative or a positive movement in equity. If it's a negative, you deduct from other components of equity. If it's positive, you add it there. Okay. Because there's a change in NCI. Okay, so one part will go to NCI, the other part will go to equity section. Because if you credit somewhere, you need to debit it also somewhere. Okay, share of post acquisition after other components. Okay, so what is the petals post acquisition? We don't have a other component for STEM. So post acquisition other component comes here. Other component change was 1 million, working 2 you can go and check, and same 70% only. Okay, you add it and this. Then we have another working here which was not there in question number 15, that is your translation reserve. Okay, so working 8 and there, the gain on goodwill, the gain on net asset, 0.54 and 9.73. It is not this. Okay, if you see here, not sorry, and what goes to NCI, only NCI portion will go. In return earnings, you should not take that. Okay, return earnings you are not taking the exchange gain. Because that exchange gain, we have a separate reserve for it known as translation reserve. So we are not adding this with return earnings. We are having a different reserve for it, translation reserve. There we are taking the exchange gain, full exchange gain on goodwill and net asset. Then we have to find out now what is the exchange gain on goodwill and exchange gain on net asset. So for that we have separate working. So exchange gain on STEM's goodwill. STEM's goodwill only will have exchange gain. For what is the other company? Was it Petal? Yeah, for Petal will not have, because there is no foreign exchange. He is not a foreign subsidiary. Okay. Whenever you have to calculate exchange gain, this is the pro forma. Memorize it. It will help you. Okay. So you should have three columns. One is the dena, one is the exchange rate, one is the dollar, the amount which you want to convert it. You start with the opening balance of goodwill. This you have already calculated it. You can go and refer the working 3. It was 31. Exchange rate. What exchange rate? At the date of acquisition 6. Opening exchange rate. Once you convert is 5.17. Okay, you divide it. 31 divided by 6. Then we have impairment. Impairment is what? There is no impairment. So forget about impairment. Okay, no need to write that line also, because impairment is not there. Okay, even if you don't write impairment, you will not lose marks. Okay, exchange gain. Remember it. Whether it's exchange gain or loss is always a balancing figure. Okay, but goodwill you have been given 31 is the goodwill. Goodwill you using the closing rate 5. Okay, or 30th April 2001, that date. This is the exchange rate. So 31 divided by 5 is 6.2. Okay, so now we have been given 5.17 and 6.2. So 6.2 minus 5.17 is 1.03. This is a positive figure, because 5.17 plus 1.03 only will give you 6.2 at the year end, the goodwill. Therefore it's a gain. Okay, so this 1.03 gain only, you cannot take it fully. It is allocated between group and NCI. Okay, so whatever goes in the translation reserve is the parent's NCI, a parent exchange gain. What goes in the NCI is the NCIs. Okay, so for this 1.03 you have to take 52% only, the stems. Okay, and for NCI it is the balance 48%. Therefore it is this and this, 0.5 and 0.49. If you see here, you see it is 0.54 here and 0.49 in NCI. Next, we are going to the next one. Exchange gain on stems. Exchange gain is on two things. One is goodwill. Now it is on net assets and profit. Remember, because even profit and net assets, we there's opening and closing figure. We convert using different exchange rate. Therefore, there will be exchange gain or loss, which is working. These two things are not there in question number 15 because both the companies were local subsidiary in question number 15. So exchange rate here. This we have calculated the net asset. Exchange rate is 6 opening, you convert. Then we have 80, we have a profit for the year. Working 2 is there. Let's go and check. That you convert using average rate because profit and loss average rate. Okay, net asset is already given and we use the closing rate, convert it. This is again a balancing figure and it's a gain, positive figure. And make sure that you know how to calculate balancing figure. Okay, most of you struggle to get the balancing figure. It is you get this one. Okay, this item you get like this across, you get through like this, then you check with this. So this is the balance figure. This is how you get the balance figure. Okay, but definitely this profit will go in. So this also same 52 and NCI 48% you need to take. Okay, working 10 is increase in ownership. Definitely we have purchased an additional, so there will be a change. And then working 11 is property, plant and equipment. There has been change in the fair value, right? So that's it. Before that, I want to go through this profit 80 because I kind of forgot this figure. It's in working 2. Okay, so everything is in working 2. We have to go through working 2 to get the profit 80. Okay, it is this 80, net increase 80. Okay, this profit you have to take. Sorry, that 80 is. That is known as profit for the year. Net asset increase means it is known as profit for the year. Okay, now we are going to the increase in ownership. So fair value at consideration. What consideration? When you have acquired that additional 10%. This is the consideration. With that you deduct the reduction. Okay, it's basically when you want to calculate the movement in equity, this is the way to calculate. From fair value of consideration minus the reduction in NCI. How much NCI reduced? Okay, so it is old. The formula is this 10 over 30. How 10 over 30? New NCI divided by old NCI. New NCI is now 10%. Old NCI was 30 because before we had 70%. Now they have acquired an additional 20, so we have 90 and 10. So 10% NCI divided by 30 into this. What is this? 46 plus 2.1. It is in working 4. You deduct it. Okay. So the balance is known as negative movement in equity. Okay, which you deduct from equity. Other components of equity you deduct this. For 46 and 2.1 we have to go to working 4 to say it, which is NCI. Okay, what is it? It is this 2. You take 10 over 30 on this 2. Petal at accusation plus NCI post accusation net assets. You take Petal's accusation. Okay, you don't have to worry about stem. Okay, because only with Petal you have done that step accusation. So only in there share NCI will reduce. So you have to take the figure of NCI at accusation plus what is the NCI percentage of post accusation net assets. Okay, so if you can see, this is the reduction. Okay, you are not reducing the equity part, you're already reducing the how much NCI reduced, 16.03. So that's 16.03 only, this one. Okay, you are reducing this figure from NCI and this from equity. the balance. Now coming to property, plant and equipment. For property, plant and equipment, rows fully you can take, this is the parent, and petal also fully you can take, but for stem there are adjustments. It was 430 divided by 5. Okay, and fair value adjustment is then working to, that was a balancing figure, we got 30. Okay, and then for that is for petal. For stem fair value adjustment, again it is in what this one 75 divided by 5. Okay, why divide by 5? Because 5 is the closing exchange rate. Fair value adjustment we just have to take because it's property, plant and equipment. It's a statement of financial position figure, so it will be exchanged using a closing figure. That's why 5. Okay. So first, this you take from statement of financial position. It's given there 430, but in D, that's why you divide by 5. This one is related to fair value adjustment 75. Again, you need to divide it by 5. Okay, for petal you can take 30 as it is, but here you need to divide by 5 because it is in D. So you take and then you get. Now we are over with all the workings, and now we can go through the consolidated. So this is how you start. Rows PLCs consolidated statement of financial position as at the date. You write. You start with asset, non-current asset. So property, plant and equipment you have working 11. Write the amount. Goodwill also you have a working. You add the this and this. Okay. From working 3 you can show. This is the figure. You add both the subsidiaries goodwill. Then we have intangible assets. Okay. 4 minus 1 because it was 4. 1 is the amortization. That's why the carrying amount will be 3. Current assets, what do you do? What do you do with the current asset? Current asset, this from the rows, you take this from the petal, you take from stem. You have to divide it by 5 first, the closing figure. Closing exchange rate, 5. Because it is in D. The other two were in dollar. So D 330 divided by 5 plus 118 plus 100. Okay. So if this amount will be 66. So 118 plus 100 plus 66, 284. Okay, you will get total assets. Make sure that you write all these things. It needs to balance. Okay, your balance sheet needs to balance. Then starting with equity and liability, share capital, only the parent, only the rows. Okay. So only rows. Share capital will be there. Retained earnings, translation reserve, this is a new thing. We have working 5, we have working 7. Other components of equity working 6. NCI we have working 4. Write all the figure from the workings. Copy paste it. Then we have total equity. Then we have total current liabilities. Here also this you divide by 5. Rest all you can take as it is. The parent and the petal. Current liabilities also this two you can take, but this you need to divide by 5. Okay. Then you take. And if you see whether it balances or not. Okay. So the total figure here is 942.2. We need to go up, and this is also 942.2. It balances. Now let us go to the second requirement. Okay. So this is the first requirement. The second one is foreign exchange part B, which one was for 8 marks. To score highly, you need a detailed knowledge of IS 21. Okay. However, solid marks can still be obtained for demonstrating a basic understanding of the standard. You need IS 21 for this. Let us read the requirement. We didn't even go through the requirements first. Okay, so the first question is for 22 marks. Just okay, it is for 22 marks. That means I should spend around 40 minutes, 39 to 40 minutes in this question. But I have finished before that. I have finished it in 34 minutes. That means it's a good time management, right? Now let us go to part B, which is for 8 marks. You have to provide a brief memo. Current accounting treatment, okay? The directors of rows. Now, we have been going through group accounting, so we know the format of group accounting. Now, this is another set of questions which comes in SBR. That is known as correct accounting treatment. Okay, they will give you some treatment. It could be correct, some might be wrong. Now, based on the standard, you have to give them the correct treatment. This is another way a question will be asked in SBR, like part B. Okay, so the editors of those are not fully aware of requirements of IS 21 in relation to exchange rate differences. They would like advice on how exchange rates would be recorded in both monetary and non-monetary assets in the financial statements, and how this differ from the requirements of the translation of an overseas entity. How this differ from the requirements of translation of an overseas entity. Directors also wish to advise on what would happen to the exchange difference if Rose sold all of his equity shares. They also want to know exchange differences if they sold all of his equity shares in STEM. Completely it is sold off. So there are many things. First, you need to know the difference between monetary and non-monetary and with the translation of overseas asset. The next one is if they sold the whole entire STEM, what would happen? Okay. So let us go through the answer. If you see how they have mentioned, just see how they have answered. They have used different subheadings for the answer. One is monetary items. They have written the answer in 3 paragraphs. Then they wrote non-monetary items. Not 3, but 2 paragraphs. That is only in 1 paragraph. Then they wrote overseas subsidiaries. Okay, so for 3 of this you are getting 8 marks. We'll see the marking scheme, how the marks are given. It is the currency issue, 1 mark per point. Okay, coming to part A. Okay, amortization of patent is 1 mark. Accusation of further interest is 5 marks. STEM, translation and calculation of goodwill, 6 marks. Wherever more workings are required, more marks will be there for that company. So you have to translate also, you have to calculate goodwill also. Retained earnings and other equity is 4 marks. And these marks are spread equally between the two companies. Retained earnings and other equity. NCI also 3 marks. Property, plant and equipment 2 marks. Other assets and liability 1 mark. Okay. These are all the items that you will be writing in the statement of financial position. Now let us start with the answer. So if you are unable to attempt this question, what you can do is stop this video, go and refresh your IS 21 standard, then you can come back and see the answer again. Do write the answer and then you can check this video and see whether your answer matches with this or not. So you first start defining monetary items. Okay, monetary items are units of currencies held in assets and liabilities to be received or paid in a fixed or determinable of units of currency. It is like you are going to receive a fixed or determined number of units of currency. Monetary items. Okay, this would include, so you are giving examples also, like bank account. You are receiving money, currency, some form of currency or money you are receiving. Receivable, payable, loan. These are monetary assets or liabilities. Non-monetary items are other items which are in the statement of financial position, such as, now you are giving the example of non-monetary also. Non-current asset, inventories, investments in equity. Okay. Monetary items are retranslated using what rate? It is retranslated. Closing exchange rate. That you need to remember. All the monetary items, for example, receivable, payable, loan, bank account, that is the year-end rate. Closing rate means year-end rate. Exchange differences on retranslation of monetary assets must be recorded in which place? If there are any differences on the monetary assets when you translate, where will it be recorded? Profit and loss. Profit and loss. This you need to remember. It's there in IS 21. If you want, you can go to the textbook also. Next, IS 21 is not specific under which heading the exchange gain and losses should be classified. If the standard is not specific relating to a certain thing, feel free to tell it. Okay, that it's not specific in this area. So it is not specific in which area? Under which heading the exchange gain and losses should be classified. They don't say you recognize the exchange gain and loss under profit or loss or under OCI. They don't tell like that in IS 21. Now let us go to the non-monetary items. Remember to give points. This is an 8 marks. So let's say you are giving 3 points for monetary, 3 for non-monetary, 2 for overseas subsidiary. So you need to divide your marks like this. How many points you are writing under each item. Now let us go to the non-monetary items. Non-monetary items which are measured in terms of historical cost. Okay, it is something to do with historical cost in a foreign currency are translated using the exchange rate as the date of transaction. So then you use the exchange rate, not the closing. You use at the date of transaction. For example, if it is non-current asset, let's say machinery, you have to see when the machinery is bought. At that exchange rate, you have to translate. Okay. If non-monetaries are measured at fair value in foreign currency, then this amount must be translated using exchange rates at the date when the fair value was measured. If you are using fair value, you have to see the date when fair value was measured. That rate you have to use. Exchange differences on such items are recorded consistently with the recognition of movement in fair value. Okay. So whenever the fair value changes, exchange rate also will there will be exchange differences also that also will be recorded. There will be consistency between that. Okay. For example, exchange differences on an investment property. A fair value through profit and loss financial asset or arising. So they are giving examples. One example is investment property because we know fair value changes there. Another example is financial asset. Fair value through profit and loss financial asset because financial asset could be recorded through other comprehensive income, but we are talking about profit and loss. Okay. Or arising an impairment or arising on impairment will be recorded in which place? Profit and loss. If it is investment property at fair value or fair value through profit and loss for financial asset or an impairment or arising on impairment. Okay, will be recorded in profit and loss. Exchange differences on the upwards revaluation of property, plant and equipment will be recorded in OCI. You should know when the exchange differences go to OCI, when the exchange differences go to profit and loss account. Under those three conditions, it goes to profit and loss, but under this condition, it goes to OCI. What is it? If it is upwards revaluation of property, plant and equipment, IS 16, PPE, it is recorded in other comprehensive income, the exchange differences. Okay, why is that? There's a reason why. Because when you revalue property, plant and equipment, that revaluation goes in OCI. That's why exchange differences relating to that PPE also goes in OCI to maintain consistency. You understand it? Now let us go to overseas subsidiary. Okay, if you're not understanding these answers, don't worry. You can go through the specific standards IS 16 or the property or the IFRS 9, then you will understand which places it will be recorded. Overseas subsidiary. Okay. Under overseas subsidiary, there are two paragraphs. First paragraph explains why it is different from monetary and non-monetary because clearly you've explained both. Second is if you sell all the equity shares, what happens? Okay. Because 1 mark for 1 point. So let us read the first paragraph. This is how you need to divide the paragraph. There should be sense. There should be some common theme in each paragraph. So that when even if you divide also people know okay this paragraph is for this specific purpose, this paragraph is for this point. So when translating a foreign subsidiary, the exchange differences on all the net assets including goodwill are recorded where? OCI. From the foreign subsidiary when you translate whatever the exchange differences relating to the net assets of the subsidiary or the goodwill, because goodwill also you will calculate definitely, they are recorded under OCI and they are held in equity. What happens? The proportion belonging to the shareholders of the parent will usually be held in a separate translation reserve. Okay. So whatever the shareholders have, we have a separate translation reserve. We just saw when we were doing part A that the parent's proportion went to the translation reserve. The proportion belonging to NCI is not shown separately but subsumed in the NCI. Okay. It is not shown separately but it is given under NCI. We saw that also in the consolidated financial statements. Second part. So this is a thing which you need to which is good if you know it. Part B, even if it's not linked with part A, okay, you might need the knowledge of IS 21 to answer this and theory parts and all, but still just see how they have used part A. The calculations what you have done in part A, you can use it in part B without actually writing the numbers and all, like how they have done from here to here. They told that how translation reserve separately we have shown the parents proportion, and for NCI how we have added it with NCI. So all those things they have taken it from part A. Sometimes when it is part A and B are like same standard, IS 21, both are IS 21, then you can use the support of part A to answer part B when you forgot the standard. But you can see that equity proportion is shown, the parents proportion is shown in the translation reserve, NCI is added with NCI. Okay. In case you forgot IS 21 rule on that, but at least you can see your calculation what you have done in part A. So from that you can take help. It's not always the case because part B sometimes might be different standard. Then you cannot take. I'm just saying in case you forget. So this also will be helpful. So keep this also in mind. Okay. Now coming to the second paragraph. If Rose were to sell all of its equity shares in STEM, cumulative exchange differences belonging to equity holders of Rose will be reclassified from equity profit and loss account. This is the part which you need to know when you sell a subsidiary. So any exchange differences cumulative, because up to that date there will be the exchange differences will be accumulating, okay, related to that subsidiary. So and we know that whenever there is a difference, exchange differences, it is recorded under other comprehensive income, but it can be reclassified to profit and loss in the future. So when is it reclassified? Only when you sell the subsidiary entirely. That day only, whatever you recorded in OCI now will be reclassified in a profit and loss account. Okay. But it only belonging to the equity holders of Rose will be reclassified from equity to profit and loss. In addition, cumulative exchange differences attributable to the NCI. Two things. One is for equity holders, you could reclassify to profit and loss account. The other one is what do you do with the NCI part? There are different exchange differences for NCI also. What do you do with that? It is derecognized. And it will not be reclassified to profit and loss account. Derecognize. Why do you derecognize? See, when you are selling entirely, okay, what happens? You will not have any NCI in your account. Okay, you will not have any NCI. There are no controlling non-controlling interest. How can there be non-controlling interest? Non-controlling interest means the one who has the smaller shares in that company, right? But now he's having 100% and you have 0%. You are selling entirely, so there is no non-controlling interest anymore. Non-controlling interest comes when there are 40-60. So 40% is known as non-controlling interest, or 70-30, 30% is known as non-controlling interest. But when you're selling entirely, you have 0%. That non-controlling interest is taking 100% from you. So he's the entire owner. There is no non-controlling interest there. Okay, so it is de-recognized. Whatever you have recognized as non-controlling interest for the exchange differences, that now needs to be de-recognized when you are selling the subsidiary. So it will be de-recognized but would not be reclassified to profit and loss. You can de-recognize it, but that amount you cannot reclassify to profit or loss, like how you have done for the equity holders. Why? This answer is not given anywhere. I'm just asking you. Just use your logic or common sense and tell me why is it so? Why NCI part is not reclassified and the equity holders are reclassified? If you use a little bit of common sense, you will get the answer. Because you don't have the non-controlling interest. Then if you reclassify it to the profit or loss, what's the use? Will it be beneficial? That non-controlling interest is not there anymore. And we know that people look the profit and loss account more than the OCI, other comprehensive income. Right? But the equity holders will be there. It can be reclassified to equity to hold because equity holders will be there in the business, no? But even if you sold entirely, so that they can reclassify to profit and loss account from equity. It makes sense because they are anyway making a profit when they are selling the subsidiary. So that can be reclassified, but not for the NCA because NCA is not there anymore. That NCA is not there anymore. So what is the use of classifying it to profit and loss account? It is only once. It's not a recurring profit, right? NCA is gone, so there's no use of reclassifying the exchange differences to profit and loss account. Okay. So that's the reason. That's a common sense logic thing. It's not given in your textbook. So even if you find in the textbook, you will not get it. Okay. So that's it. So finally and successfully we have completed 16 questions for group accounting. Okay, go now. It's your job to go through all the 16 questions, revise it again, and from question 17 onwards from tomorrow, I'll be starting ethical questions. Okay, question on ethics with the how to get the professional marks. There are two professional marks for that question in your section A, question number 2 for SBR. So we'll go over that from tomorrow onwards. Okay, so see till then, take care and God bless.